Picture a well-dressed advisor across a wide, polished desk. He slides a glossy folder toward you and smiles. Inside is a plan that will quietly cost you a fortune, not through fraud, through one small number, a 1% annual fee. Over a working lifetime, that single percent can swallow more than a quarter of your final nest egg. In one common example, a $1 million retirement shrinks to about $747,000. Same saving. Same market. One fee. Meanwhile, S&P Dow Jones indices keep score on the professionals, and the score is brutal. Over 20 years, roughly 92% of active U.S. stock funds lost to a plain index. Here is the boring truth, the one the wealth management industry would rather you never sit still long enough to hear. The dull, cheap, obvious approach usually wins. So here's the question that quietly decides your retirement. Are you paying for advice or paying for a logo? Most people never ask. They see a friendly face and a confident chart, and they sign. The cost of not asking is not small. Fees do not feel like theft because they arrive in tiny slices. 1% this year, a 0.25% buried inside a fund. A small sales charge you never quite notice. Each slice looks harmless on its own. Stacked across 30 years, they compound against you just as your savings compound for you. Think about that for a second. The exact force that is supposed to build your wealth is quietly working for someone else. Money that leaves your account early never gets the chance to grow. You do not just lose the fee. You lose every dollar that fee would eventually have become. That is the real price tag, and it never shows up on a statement. Over the next few minutes, I will walk you through 3 layers of this: the small fees you can actually see, the bigger structural bets that are tilted against you, and what wealthy people do instead. Stay to the end. The last one ties the rest together, and it explains why the winning move is the one almost nobody here can sell you. It is simple. That is exactly why it stays hidden in plain sight. Let's start with the fee everyone quotes and nobody feels. The classic 1% of assets under management. It sounds tiny. 1%. A rounding error? Here's what almost nobody tells you. You do not pay that fee on your gains. You pay it on your entire balance every single year in good markets and bad. Imagine a neighbor who trims one strip of your lawn each spring and charges 1% of your whole house, not 1% of the grass, the house, every year. That is the actual shape of the deal. To be fair, 1% to manage genuine complexity can be reasonable. The trouble is what that percent becomes over decades. Run the math on a lifetime of saving, and a flat 1% fee can quietly erase more than a quarter of your final balance. In that common example, a $1 million nest egg lands closer to $747,000 instead. Same contributions, same market returns. The advisor did not lose your money. The fee did. And here is the twist most people miss. The actual dollars you handed over were far smaller than that gap. Most of the damage is the growth those dollars never lived to create. And here is a detail that should sting. That 1% gets charged whether your portfolio goes up, sideways, or straight down. In a losing year, the market takes a bite and the fee takes another, from a smaller plate. You share every loss and rent out a slice of every gain. Imagine paying full price for a gym membership in the months you never once walk in. The bill simply does not care about the result. Now scale that indifference across a lifetime. Now add the fees hiding underneath. Your advisor places you in mutual funds, and those funds charge their own expense ratio on top of everything else. For years, the industry average sat near 0.80% of your money annually. According to Morningstar, the asset-weighted average across U.S. funds fell to roughly 0.32% by 2025. That is genuine progress. But plenty of older funds still charge 5 or 10 times the cheapest options. Paying 1% for a fund when a near-identical index version costs 0.03% is like buying bottled tap water at steakhouse prices. Same water. Fancier label, bigger bill. Then there are the fees designed to be forgettable. Sales loads that skim a few percent the moment you buy in. Trailing commissions paid to whoever sold you the fund. Trading costs that never appear as a line item. None of these feel like much in isolation. My favorite detail is that many of them are technically disclosed, in a document the size of a phone book that no human being reads. Legal? Completely. Obvious? Not remotely. That is the point. And some products exist mainly to be sold, not owned. Certain annuities and proprietary funds come loaded with surrender charges and rich commissions baked into the fine print. They are pitched as safety, and safety is an easy thing to sell to a nervous saver. Sometimes that safety is real. Often it is an expensive wrapper around something you could own for a fraction of the price. If a product needs a very motivated salesman to explain why it is wonderful, that is worth noticing. The enthusiasm is frequently a commission wearing a smile. There is also a quieter trick called the double layer. You pay the advisor his 1% to choose funds, and then you pay those funds their own fees underneath. So you are charged twice on the same dollar. It is like tipping the waiter to hand you a menu, one that already has a service charge printed on it. Perfectly normal in this world, almost never explained in plain English. Once you start seeing these layers, you cannot unsee them, and that is exactly when the bigger picture snaps into focus. Here's the quiet part where it all adds up. 1% to the advisor, 0.5% to the funds, a sliver of trading cost on top. Individually, each looks like a rounding error you can shrug off. Together, they can pull 1.5% to 2% off your return every year for the rest of your life. Think of it as a slow leak in a car tire. You never hear it hiss. You just notice many miles later that you never quite arrived where you were headed. And the small stuff is only the surface. The deeper you dig, the worse the structure underneath gets. So you are paying real money for expertise. Surely that expertise beats the market. This is where the boring truth turns genuinely cold. Every year, S&P Dow Jones Indices publishes a scorecard called SPIVA. It measures active fund managers, the highly paid professional stock pickers, against a simple index that just owns everything. In the year-end 2024 report, over 1 year, about 65% of U.S. large-cap active funds lost to the S&P 500. Stretch it to 5 years, and 76% lagged. 10 years, 84%. 20 years, nearly 92%. Across 2 decades, roughly 9 out of 10 professionals could not beat a fund that buys the whole market, and then sits perfectly still. That is not a bad season. That is the base rate. It is like a casino where the costly tables lose 19 times out of 20. And the handful of managers who do win this year rarely stay on top the next. Today's 5-star fund is usually tomorrow's quiet footnote. Chasing last year's winner is a reliable way to buy high and sell low on a schedule. There is even a name for the trick where a fund charges active prices while secretly hugging the index. They call it closet indexing. You pay for a racehorse and quietly own a carousel pony. It gets quietly worse because the scoreboard is kinder to the pros than reality is. Funds that perform badly often get shut down or merged away, and once they vanish, they drop out of the averages. Picture a race where the slowest runners are erased from the results before the photo is taken. Even after that flattering edit, the professionals still lose to the index most of the time. That tells you the honest numbers are probably rougher than the brochure ever admits. So why would anyone still sell you active funds? Follow the incentive, and it all makes sense. Here is where one word does an enormous amount of work: fiduciary. A true fiduciary is legally required to put your interests first, ahead of their own paycheck. Many salespeople who look and sound exactly like advisors operate under a looser rule called the suitability standard. Suitability only requires that a product is appropriate for you, not that it is the best or the cheapest one available. That gap between appropriate and best is a canyon. Under suitability, someone can steer you towards the fund that pays more as long as it is merely suitable. It is like a waiter allowed to push the dish with the best kickback, instead of the one you would actually enjoy. And notice how the whole thing is sold to you. It arrives wrapped in complexity, jargon, and a faint sense that you are not quite smart enough to do this alone. That feeling is not an accident. Complexity is profitable because a confused customer reaches for a professional and stops asking about the bill. Simple truths are hard to charge for. A frightened saver is a loyal customer. Keep that in mind every time a plan feels deliberately complicated. The fog is often the product. Let's be honest. Most advisors are not cartoon villains twirling a mustache. They are ordinary people inside a system that quietly rewards selling you more expensive products. The incentives do the damage, not the individuals. And the single most expensive product of all is time surrendered to fees. John Bogle, the man who founded Vanguard, gave it a name: the tyranny of compounding costs. His arithmetic still stings decades later. Over 50 years, $10,000 growing at the market rate becomes about $469,000. Skim a few percent a year in costs, and that same stake becomes about $145,000 instead. The investor put up 100% of the money and took 100% of the risk. He kept 31% of the reward. The financial system quietly kept the rest. That one sentence is the entire game, and nobody who profits from you wants it stated plainly. So what do genuinely informed people do differently? The answer is almost insulting in how boring it is. They own the whole market at the lowest possible cost, and then they mostly do nothing at all. It's not one thing, it is a small handful of dull habits repeated patiently for decades. Start with the first one. They favor low-cost, broad index funds. When a total market fund charges 0.03% and a comparable active fund charges 1%, the cheap one begins every single year with a massive head start. Over a lifetime, that head start turns into real houses and real freedom. The second habit is letting time carry the load. The reason fees hurt so badly is the very same reason patience pays so richly. Compounding runs in both directions. A dollar invested at 25 has 40 years to multiply on itself. That same dollar at 45 has only 20. Time in the market, not timing the market, is the quiet engine under all of it. The wealthy are not better at predicting next quarter than you are. They are simply much harder to scare out of their seats when the headlines scream. The third habit is keeping the whole thing cheap and visible on purpose. The industry has been dragged into getting cheaper whether it liked it or not. Morningstar estimates that falling fund fees saved investors billions of dollars in a single recent year alone. That money did not evaporate into thin air. It stayed in ordinary accounts, compounding for ordinary people. You can join that exact group tomorrow without one phone call to a salesman, simply by paying less and holding longer than everyone around you. There is a fourth habit that matters more than the flashy stuff. They automate, and then they stop touching it. Money moves into the account on payday, before it can be spent or second-guessed. No timing, no hunches, no panic selling at the bottom. A boring monthly transfer beats a brilliant hunch almost every time because it removes the most dangerous part of any portfolio, which is the human staring at it. They rebalance once in a while, mind the taxes, and otherwise leave it alone to grow. Before any of the fancy stuff, they grab the free money first. If an employer matches part of your retirement contributions, that match is an instant, guaranteed return. No fund can promise. Turning down a full company match to chase a hot stock tip is like refusing $1 so you can gamble on a dime. The informed take the match every time before they do anything clever. The boring guaranteed win comes first. The excitement, if any, comes much later. And the final habit is ruthless simplicity. A complete, sensible portfolio can fit on a single index card, sometimes just 3 broad funds covering the whole market. That is not a beginner's version they will graduate from later. For most people, that plainness is the finished product. The urge to add complexity usually serves the seller, not the saver. When your plan is simple, cheap, and automatic, there is very little left for anyone to charge you for, which is the whole uncomfortable point, and it leads straight to the twist. Now notice what is completely missing from this entire list. No secret fund, no exclusive access, no genius manager with a private phone line. The quietly wealthy are not buying something you are locked out of. They are refusing to buy the expensive things you have been told you need. The hardest part is not the strategy, because the strategy fits on an index card. The hardest part is sitting still while everyone around you looks busy, sophisticated, and important, which raises one obvious question. If this approach works so well, why has no one ever pushed it hard on you? Let me give the other side its fair hearing, because the honest picture has a real exception in it. A genuinely good advisor can be worth far more than they cost. Vanguard studied this directly in the research they call Advisors Alpha. Their estimate is that a skilled advisor can add somewhere around 3% per year in net value for a client. Notice where that value comes from, though. Very little comes from picking hot stocks or timing the market. Most of it is behavior. It is the calm voice that stops you from selling everything in a crash. It is smart tax placement, disciplined rebalancing, and a plan you can actually stick to. That coaching alone can be worth more than the fee, because the average investor's worst enemy is the person in the mirror. There are also real situations, a business sale, an inheritance, a messy tax year, where good advice pays for itself many times over. The point was never that all advisors are useless. The point is that you should know exactly what you are paying and exactly what you are getting for it. Pay a fair price for real planning. Refuse to pay a fortune for expensive products dressed up as wisdom. Here is the part that ties everything together, and it is stranger than a simple fee complaint. The best strategy is hidden because it is so cheap. Think about the incentives one more time. A 1% fee only pays the bills if there is a product attached to it. A broad index fund held quietly for 40 years generates almost nothing for anyone to sell. There is no glossy folder for patience, no commission on doing nothing. No sales conference in a warm city celebrating the man who simply held on. The whole machine is built to move you, because movement is where the money is made. Every trade, every switch, every clever new product is another chance to charge you. Stillness cannot be monetized, so stillness rarely gets recommended. That is why the boring truth stays buried. It is not that the industry is hiding a secret formula. It is that the winning formula is too plain and too cheap to build a business around. The thing that makes you rich is the one thing almost no one can profitably sell you. So the next time an expensive strategy sounds thrilling, remember who the thrill is really for. Here is the whole idea in a single line. The strategy that builds the most wealth is the one nobody can make a living selling you. Picture two people who started on the very same day with the very same paycheck. One chased every hot tip and shiny folder, hopping funds, paying loads, always sure the next clever move was the one. The other bought a plain index fund, kept the fees near zero, and mostly ignored his account for 30 years. The chaser was always busy and always certain. The builder was quietly, almost boringly patient. 30 years later, the busy one has a drawer of old statements and a lot of stories. The patient one has the house, the freedom, and the quiet. Remember that advisor at the polished desk from the very start. The folder was never the plan. The plan was to keep more of what you earned and to wait. If this made the fees finally make sense, subscribe and keep it boring. Your future self is counting on it.